Beware of more market volatility as the US debt ceiling nears. On August 1, America's debt ceiling is due to go into effect again. Until a new debt ceiling bill is passed, the Treasury Department will be unable to issue new debt and will only be able to use the $832 billion in TGA balances and unconventional measures for government spending and old debt repayments. Under the base scenario, we expect the debt ceiling issue to be resolved in late September or October, the Treasury's ability to issue debt to resume, and the rising TGA balance to result in tighter liquidity margins around $300 billion, which would disrupt highly valued risk assets. If the debt ceiling issue is not resolved in the next 2 to 3 months, the risk of a technical default could trigger risk aversion. One of the most pressing issues before Congress is the debt ceiling, which expires on July 31 and will be reimposed on August 1. The new debt balance is the $22 trillion debt ceiling before the 2019 Bipartisan Budget Act went into effect, plus additional debt balances during the act. The Congressional Budget Office (CBO) estimates the debt outstanding at $28.5 trillion as of June 30, but the final debt limit should be added to the additional balance through July 31. First, basic background. What is the debt ceiling? The debt limit, also known as the debt ceiling, is the maximum amount of debt the Treasury Department can issue. The debt ceiling consists of public debt and intergovernmental debt. Public debt is securities issued by the federal government to the public, including all federal debt held by individuals, corporations, state or local governments, Federal Reserve banks, and all entities other than the United States government. Intergovernmental debt is government debt held in government accounts such as trust funds, revolving funds and special funds. It is primarily used by the federal government to keep records on government accounts. These securities are not traded on the market. The latter can provide the government with a cushion through extraordinary measures when it faces the debt ceiling. As of June 30, the outstanding national debt of the United States was about $28.5 trillion, of which $22.3 trillion was public debt and $6.2 trillion was intergovernmental debt. 2. Current situation. Two-pronged to provide cushion. In addition, since the debt ceiling was not raised in time, the Treasury cannot issue new debt and will use unconventional measures to fund the government. Such measures essentially use accounting techniques to bring down the balance of government debt, thereby creating room for the federal government to borrow in the short term. The CBO estimates that the combined balance of TGA accounts and unconventional measures will provide the federal government with a cushion of about $832 billion before the start of the new fiscal year on October 1. However, that amount is all the space available. So how long will the money last? When will the so-called X date, the moment when the government will technically default, come? That is, with TGA account balances exhausted and room for unconventional measures exhausted, the Treasury could face a moment of technical default. According to the Bipartisan Center for Policy Research, X date would occur in mid-November in the baseline scenario, and the CBO predicts X date will occur in the first quarter of the new fiscal year, most likely in October or November. Although due debt ceiling isn't the first time, after several governments also threw unconventional measures to prevent the breach, the impact of high government spending and government deficits, and the uncertain economic recovery process makes the X to predict faces huge uncertainty. The Bipartisan Policy Center for the Study of Prediction of Pessimistic Scenario, the X will be in early October. 3. Future outlook. How to solve the problem. In theory, there are two main ways to suspend or raise the debt limit. First, the regular legislative process, in which bills are passed by simple majority votes in both the House and Senate and signed by the President. But in the case of a filibuster in the Senate, 60 votes, 3/5, are needed to break the filibuster and bring the bill to a vote. Second, change the debt ceiling through the budget reconciliation process. The budget reconciliation process requires a simple majority, more than 50 votes. Democrats currently hold 50 seats in the Senate, requiring a vote from Vice President Harris. All 4 debt ceiling suspensions since 2015 were passed under the regular legislative process, but proposals to suspend the debt ceiling were all included in bills related to the budget for the new fiscal year. In addition, unconventional measures were used to keep the government operating until the new debt ceiling suspension began in 176 days in 2017, 63 days in 2018 and 153 days in 2019. Under the legislative process on Capitol Hill, a lawmaker's proposal is first sent to a committee or subcommittee related to the legislation for consideration. Committee members carefully study and debate proposed legislation at this stage. Committee panelists can make changes, vote on legislation, etc. If the proposed legislation is not approved at the committee stage, it will not go to the House and Senate for a vote. Congress has yet to agree on how to deal with the debt ceiling because of a wide gap between the two parties over the new fiscal year budget. The combination of history and current circumstances makes it unlikely that the debt ceiling will be resolved by the end of July. In addition, according to Senate Republican leader Mitch McConnell, who said he believed all Republicans would vote against resuspending the debt ceiling, giving Democrats an unlimited borrowing limit until a tax and spending plan is finalized is almost impossible. That means that even if Congress were to form a unified bill, it would likely be blocked by a filibuster in the Senate, and Democrats would struggle to muster 10 additional votes when Republicans are likely to reject it en bloc. We expect the debt ceiling issue to be included in a spending package Democrats are trying to push through, using the budget reconciliation process to get around the filibuster of regular legislation. But the current partisan tug-of-war and congressional delays make it less likely that the debt ceiling will be resolved before Congress heads for its summer recess, August 9th to September 10th, and we expect the issue to be resolved as early as late September or October. 4. Potential impact. Disturbance of short-term financing market and market sentiment. Dynamic changes in TGA accounts, reserve balances and short-term treasury bills can disrupt money markets, treasury rates and risk assets. Until the debt ceiling issue is resolved, TGA balances are likely to fall sharply, limiting the Treasury's ability to issue bonds and further exacerbating the scarcity of Treasury bonds, putting further downward pressure on repo and Treasury rates. As we discussed earlier, the Fed has bought almost all of the net Treasury issuance over the past 2 months, and the strong demand for Treasury securities due to short covering and the rebalancing of large managed equity bonds and relatively limited supply of Treasury securities has put downward pressure on interest rates. In addition, the banking system, with historically high reserve requirements, is under pressure to absorb deposits, and a large amount of liquidity is flowing into money market funds. The Fed Reverse Repurchase Facility, (NRRP), rate of 5 basis points is more attractive in the face of lower repo and Treasury rates, and we expect further inflows into NRRP until the debt ceiling issue is resolved. That process could then be reversed once the debt ceiling is resolved, expected in late September or October, and Treasury's ability to issue debt is restored, allowing money to return to TGA accounts and potentially easing the downward pressure on Treasury rates. On the other hand, rising TGA balances will result in tighter liquidity margins of around $300 billion, which could disrupt highly valued risky assets. But if X-Day does come or approaches, the Treasury faces the risk of a technical default, which could trigger risk aversion in the market. In August 2011, during the debt ceiling crisis, Standard & Poor's cut the U.S. sovereign rating from the top-notch AAA to AA+, triggering a risk-off mood in the markets. Although we expect the U.S. government technical default risk is low, but considering the epidemic, have gained greater risk assets, valuations are high, the current of policy expectations and potential risks are sensitive. If both parties seesaw makes the solution of the debt ceiling to delay, don't rule out the possibility of market volatility even adjustment.